Hello traders, welcome to another episode from Ultra Investor. Do you know that market makers manipulate the traders to enter the markets in the wrong direction? They do so by grabbing the liquidity. It is done only to increase profits. For example, suppose the trend is an uptrend, and market makers want to move the price from point A to B. To push the market up, they have to buy a large number of shares. But there is one problem. As the retail traders think that the current market is an uptrend, no one wants to sell the shares. So the market makers deceive traders to believe that the trend has changed. Then the market makers hunt the sell order stop loss and continue the move to the upside. Therefore, in this episode, we will explain how market makers trap retail traders and how to use the market maker strategy to make more profits in the market. If you're keen on being updated with our latest content, kindly subscribe to our YouTube channel and enable the notifications. By doing so, you'll be the first to know whenever we upload new videos. Also, comment below with your thoughts and questions and we will do our best to answer them all. Before we explain the market maker's trading setup, there are two critical principles you have to understand. One is about trends and the other is fakeouts. Let's start with the trend. In an uptrend, the market makes higher highs and higher lows. But the markets never move clearly like this. It may form some choppy consolidations like this. Now the question comes: are we still in uptrend? The answer is yes. We are in an uptrend until the price breaks the higher lows and close below it. The other question is, which of the low is higher lows in this choppy consolidation? The answer is simple. We cannot tell any of these lows as higher lows until the price breaks and close above the higher high. And if the price close below the higher low, and then we can say that there is a possible trend change. The same principle applies to the downtrend. Let's analyze the real chart. Here we are in a downtrend. The chart is making lower lows and higher lows. As we have already discussed earlier, we are in a downtrend as long as the price stay below this high. And if in the next move, if the price breaks and closes below the structure level, then the new lower low will be this. We will be in a downtrend until the price is below this newer lower low. After making some lower lows and lower highs, if the price breaks and closes above this high, then we can say we are no longer in a downtrend and soon there will possible uptrend. After gaining knowledge about the fundamental structure of the market and its trends, let's discuss fakeouts. These happen when the price breaks through a chart pattern but then retreats inside it. For instance, if the market is experiencing an uptrend and breaks past the resistance level toward the higher side. If the market declines to the specified zone, it is anticipated that this level will function as a support and push the market back up. However, if the market effortlessly breaks through this level, it is considered a fake out. It's important to note that fakeouts suggest that there may be a shift in momentum towards the opposite direction and an indication of a possible change in direction. Now that we have an understanding of the necessary market concepts, such as makers and trading setups, we can proceed to the next step. Assuming we are still in an uptrend, the market makers aim to move the market from point A to point B. Assuming an intention to purchase 1,000,000 shares before reaching point B, the issue arises that the current market trend is upward and the probability of an increase in price is high. As a result, there is a surge in demand for purchases while sellers are scarce. If market makers were to enter the market at this time, the price would immediately hit the B point, leaving them with no opportunity to purchase the desired amount. This is a strategy used to manipulate people into selling their shares. A consolidation area is created and then broken into the downside, leading people to believe that the uptrend is coming to an end and prompting them to enter short positions. This is when market makers take advantage of the situation and enter the market, gathering all the liquidity they need and pushing the market back up. Here's our strategy for this market: when the price returns to the consolidation zone, we see it as a chance to buy. We'll enter a buy position and place our stop loss below the consolidation level to protect our investment. Our target is the next level of structure. To summarize, our approach involves two steps. Initially, after analyzing the chart, we have concluded that there is an upward movement trend that will continue until the stock breaks and closes below the current higher low point. Therefore, we have a positive outlook for the market. Secondly, we detected a fakeout which may indicate a potential shift in the short-term downward trend. Consequently, we plan to buy stocks again when the market breaks and closes above the consolidation range. An essential aspect to consider is that this particular technique is classified as a trend continuation approach. Therefore, it is advisable to exercise caution and refrain from implementing it in every market situation. It is best utilized when there is a clear trend visible. Now, let's analyze this trading tactic on an actual chart. We can see this as an upward trend by observing the higher highs and higher lows. As long as there is no close below the latest higher low, we can confirm that the trend is still up. After that, we can monitor the price action to identify potential opportunities for long positions. Observing the market, it can be seen that it formed a consolidation zone which later broke out to a downward trend. As a result, many traders took a bearish stance and shorted the market. However, the price soon returned to the consolidation area, disregarding the previous support which had now become resistance. This resulted in a clear fake out, indicating that the market's overall direction was bullish. This presented an opportunity to enter a trade. Our strategy involves waiting for a candle to break and close within the consolidation area, which serves as our entry point while safeguarding our stop loss below it. Once the price reaches our first or second target, we can close half of our position and track our profit accordingly. It's important to remember that this strategy is not limited to any particular time frame or session. However, it's always recommended to conduct your own backtesting to determine which parameters work best for your trading style. So, I hope this video has been helpful to you. If it has, kindly show your support by giving it a thumbs up and subscribing to our channel for additional trading strategies and tips. Good luck with your trades.